Good afternoon, I'm Bob Mason, I'm a CPA, and I always find it interesting how many people will turn out on a Saturday to hear a CPA talk. Well, okay, maybe you're not really here to hear me talk. And I do have my information written, and it's not because I have difficulty speaking in front of people. I'm actually one of those CPAs that like to talk, so I have to have it so that I actually finish on time. So I'll start and we'll go through this. So I'm Bob Mason. Thank you for the opportunity to speak with you today. I have over 30 years of experience as a CPA, and I'm an owner of Coast Financial Services, a local CPA firm here in Capitola. We're a full-service firm providing accounting services to small businesses and individuals. We also have a specialty in tax resolution. So what that means is if you have problems with the IRS, perhaps unfiled tax returns for many years, or you have an audit ongoing with the IRS, we can represent you. We are also a wealth management firm. I have my licenses for securities and so forth, and we can help people with retirement planning and investments. Today I'm going to talk about the tax implications of foreclosures, deeds in lieu of foreclosure, short sales, and other distressed sales of real property. Under the current tax law, in general, taxpayers can exclude income from the discharge of debt on their principal residence for the years of 2007 through 2012. So the operative word there is under current law. That means that's not always the case. So basically, under tax law, foreclosure and those types of activities can lead to taxable income. And that's usually quite a shock to folks. I've sat with many folks. When we explain this, they're like, oh my goodness, that's a double hammer, isn't it? So it's important that we understand the tax implications. This applies to mortgage debt up to $2 million, $1 million if married filing separately. The exclusion only applies if the income is due directly to the decline in the home's value. Because foreclosures are treated like sales for tax purposes, there may be a taxable gain. And therein lies what usually gets folks, because they don't see the foreclosure as actually a sale. But it's a deemed sale in the eyes of the IRS, and it's something to take important note of. Again, there are two types of income that can result. The first is cancellation of debt. However, cancellation of debt income is not always taxable. There are exceptions. The most common are bankruptcy, insolvency. That's when your debts outpace your assets, and it's for a moment in time. It's at the moment of foreclosure. Certain farm debts and non-recourse loans. Recourse debt is debt that you are personally liable for. Examples of recourse debt can be refinance debt or home improvement debt, as well as non-owner occupied property. Non-recourse debt is for which the lender's recourse is to only repossess the property. Examples under California are loans to purchase owner-occupied property 1 to 4 units, or when the seller carries back financing for all or a portion of the purchase price on real property. The second type of income is capital gains income, which is when the debt forgiven exceeds the fair market value of the home. So often what happens to folks is that the original mortgage debt was perhaps incurred many years ago, and there's been subsequent debt added to the home. So the fair market value comes important, and at that fair market value, although lower than one would want it to be, maybe when those debts were put on the home, if it's sufficiently high enough, and it's greater than, and it's less than the mortgage debt, you can end up with a taxable income event. The second is capital gains income, which the debt is forgiven exceeds the fair market value. Now let's work through some quick examples. Figuring income from cancellation of debt and figuring gain from foreclosure. Okay, someone said to me, you're not really going to work math problems today, are you? Well, I am a CPA, and so I do have a comfort zone, and I guess I always retreat back to that. But we'll go through this rather quickly. But I think it's important to go through these examples, and if after the talk you want to have documents that explain these examples, I have a real quick cheat sheet from the IRS that states it rather briefly, which is basically what I've put up here on the board. Or if you want something more involved, I do have a 24-page document from the IRS that, with small print that takes you through the whole calculation. So quickly, a home was bought in August 2005 and lived in until the time of foreclosure in September of 2007. The original purchase price was $170,000. The home is worth $200,000 at foreclosure, and the mortgage debt canceled at foreclosure is $220,000. So step one, figuring the cancellation of debt income. You take the total amount of debt, $220,000, and you subtract from it the fair market value of the property. If less than zero, I guess you get to enter zero, but if there's $20,000, as in this case, left over, then you're going to have cancellation of debt income. The amount on line 3, the $20,000, is taxable unless you meet one of the exceptions. However, if the canceled debt is considered qualified principal residence debt, then there's no taxes during the years of 2007 to 2012. Step 2, figuring the gain from foreclosure. You take the fair market value of the property at foreclosure, $200,000. You calculate your adjusted basis. Now, does anybody in the world know what adjusted basis is except for an accountant? Probably not. Some people do, they're shaking their heads. Realtors, of course, do, and so do mortgage folks. So the adjusted basis is what you've paid for the home, in addition to any substantial improvements that you've done to the home. So that would be your adjusted basis. Now, if it's income property or investment property, the adjusted basis is a bit more complex because you have to take into account your depreciation. And of course, you see that the debt forgiveness rules are for principal residents. So a lot of folks are coming into our offices talking about their